Welcome back to CEO Money. I'm Michael Yorba. Thank you for joining with us. All right, I have Tom Weickgenant. He is an enrolled agent and the Chief Tax Strategist with Economic Strategist with me here today. Tom, thanks for being back here.
Well, it's good to be back, Michael.
All right, you and I had a real good conversation this morning about today's talking points. Tom has very much educated me on a lot of things, and we're going to bring them out to you. All right, Tom, there's been some ruling changes, and I wanted to start drilling down into these IRS ruling changes as they affect personal and corporate entities. So the first one, if I may, is the QBI. It's Qualified Business Income Deduction. Give our audience, if you will, a overview of what it is and then how the changes will affect us.
Okay, well, QBI, or Qualified Business Income, was created because our corporations got a tax break from 38.9% statutory rate down to 21% flat rate.
Right.
And which was quite a nice break for them.
Yes, hooray for our side.
But the problem with that is you have other small business in this country, and many of them are sole proprietors, they're farmers, they have a multi-member LLC or a single-member LLC, that type of business. They didn't benefit from this, and so they wanted to give them their own little deduction, and so they created a qualified business income. And so it takes all those types of income and combines them and gives them a deduction. It's from taxable income.
Now, is that deduction based on their tax rate relative to their income stream, or are there other factors involved? Because this can get really complicated and in the gray area.
Yeah, it's very difficult to understand, but it's basic. The amount that it comes up to, it basically, the higher their tax rate, the more this deduction means to them. If they're in the upper brackets, then it's going to be worth more. But it's a flat 20%, basically, of their qualified business income.
So it's capped. Before,
Yes.
Was there a higher rate or no cap?
This is new. There was no QBI before this year.
Okay, so they were completely at risk for
Yeah,
much more cost.
All of their income was taxed, 100% of it, their taxable income, the net business income.
That's the point I was trying to bring up.
Yes.
Are there any other changes on the QBI that our audience should know about?
Well, the QBI, there's certain trades and businesses that are what they consider specified service trades or business, such as doctors, accountants, lawyers, consultants, and anything that's kind of a reputation-based service business. And they're limited in their QBI in the sense that once their income gets up to a certain point, they start losing that deduction. And by the time, say, if you're married filing joint and you're a doctor, if you get $415,000 in net income, you have no more QBI deduction.
Now, it's not just doctors, it's professionals, doctors, lawyers.
Basically professionals, yes. Okay. I just use doctors because it's kind of hard for most people to imagine a doctor earning less than $415,000. So it's easy. They basically don't have a QBI is what it amounts to, many of these professionals.
Got it. And then if you have a reputation that you work with, not a doctor or lawyer or like, say, me, right? Somebody like me, I have a different threshold, right?
Well, it's the same. You have that same type of threshold. Once you get up there, starts around, if you're married, single, it starts at $157,000, and by the time you get up at $207,000 of taxable income, it goes away.
That's what I was trying to get to.
Right.
Okay. All right. Now, there's other changes that have happened in the law. I think, look at my notes here, switching from employee to contractor. This is a tricky one because people need to understand this, or you can get your foot in the bear trap real quick here.
Well, there's a lot of employees who are fairly upset, and with good reason. They lost the employee unreimbursed expense deduction on the Schedule A. So they no longer can take that, and yet they may have these expenses that they have to foot the bill at their place of work. Mm-hmm. Well, so now they're starting to think, well, maybe I should go in business for myself, be my own boss. And that can be a tricky, and then plus then they would get the QBI deduction, because they would have their own business.
Right.
Well, that's you have to do a lot of thinking about that one, because number one, when you go into business for yourself, all of a sudden you're responsible for things like your benefits. You know, you may have received health insurance from your employer. Well, now you've got to add that to your expense list. And also, when you also basically are responsible for all of your self-employment, all of your Social Security, because the employer matches your Social Security withholding, but now because you have no employer, you're responsible for that. And so if you take someone, say, making $75,000 as a W-2 employee, and all things being equal, even with the QBI, the 75,000 W-2 employee has a couple thousand more in net income, take-home pay, than you would as your own business. So there's a lot of things to think about. If you know that you're going to really have a great chance of increasing your income, then it's time to think about being your own boss.
So you still need to get with the person that helps you with your taxes or
Right.
does them for you, because you've got a critical mass point where if you're not going to have this much income, it's not worth it. You're
Exactly.
going to end up losing on the deal by thinking you're getting more freedom and by being your own boss. Am I connecting the dots correctly on that?
Yes, you are, and very, very much so. And the other thing is, if you don't have any change other than you go from being an employee to being your own boss, but you're doing the same thing, and the IRS scrutinizes, they will not consider you self-employed.
So you need to have a material change, either more clients or a different way of doing business.
Right.
Okay.
And you also will not be eligible for the QBI because of that.
That's a big cost.
Yes.
I got it. Let's move on. Tax rates expanded to create a slower climb from lower to highest. You showed me the chart today. I was amazed how broad they have become from what they were. They were narrow bands, and now they're different. Tell our audience about that.
Yes, they've added a few slots at the bottom, so you go from 10 to 12 to 24. So you've got some more brackets at the lower end of things, plus the income that goes within each bracket has expanded. So it takes you longer to go from one bracket to the next. And so that really benefits those at the mid-range to the lower end of the income range. So that's a big plus. It lowers taxes for a lot more people that way.
Right, there's 7 rates.
Yes.
And, you know, there's been some merit. I'm going to get off the reservation for a minute here, and I can say that I'm a Native American. But the things that have come up in the tax law is, why don't we have a 10% tax law? Why is the more you make, the more percentage of what you have to give out is something that is in our code? It seems almost counterintuitive for a capitalistic society.
I would agree with you on that. As flat rate makes a lot of sense. You make a flat rate, take away all the deductions, it simplifies things. It would actually make the IRS less necessary. I mean, they could scale back on their personnel a lot, and there's nothing much to audit. I mean, you get your income and you pay a tax.
What are the big things? We've got about a minute and a half left in this interview. What are the big things of the 3 topics that we spoke about today that you think people really need to pay attention to? Because after I sat with you for an hour or half an hour, the time we could squeeze with each other, it seems to me that there are some gray areas. I mean, they're going to let us know when they make the rules in the middle of the game how they're going to change. And that'd be after they change it.
Right. It's very important to understand the QBI. And really the number one thing is this tax change really benefits people like me who are experts in the tax law, because people are not going to be able to get the full explanation by going to their tax program. I mean, it will do a lot of the work for you, but you got to know which places to put it in and what qualifies. And the fact is that all of these types of income go into QBI, whether you've got a partnership, you've got a sole proprietorship, and a farm. If you have all 3, they get added together to calculate QBI. So it gets pretty complicated.
Yeah, they better be in touch with you or their favorite enrolled agent, which, by the way,
That's
they're
right.
not growing on trees. Tom, thanks for being here.
Okay, well, thank you. It's been great being here.
I'm glad you were here. All right, thanks for watching with us. You've been watching CEO Money with Michael Yorba. Like us on Facebook, follow us on Twitter, subscribe to our YouTube channel. We'll talk to you soon.